I think there is going to be a proliferation of applications where, we have already, I mean, the main ones we know, obviously, ChatGPT, Midjourney, there is the new kid in town, Sora. And when you look at what is happening in the background, that is a lot of inferencing, that is a lot of computing. And we need the architecture to constantly get better over the course of time. And with the inferencing market, kind of like a secular part of the overall AI theme, I think stands to benefit. I mean, yeah, NVIDIA will stand to benefit as this sort of remains like a secular theme within its overall different revenue categories in the coming quarters, in the coming years.
Welcome back, everybody, to another episode of The Pragmatic Investor. My guest today is Amrita Roy, a fellow Substack author and an expert when it comes to connecting the dots between macroeconomics and technology and upcoming trends in the world. So, we had a great conversation today, of course, about the Nvidia earnings, everything to do with Nvidia and AI. Amrita gave us her outlook for this new and exciting technology. And from then on, we also talked about the more general macro picture and how this all fits in. Are we going to see inflation or deflation? What are the potential risks for the US economy, namely commercial real estate? And how is it that other economies such as Germany, UK, and Japan are entering into recession while the US is doing so well? So, as always, guys, I really hope you enjoy this conversation. Please go ahead and follow Amrita on Substack if you're not doing that already, and like, share, and subscribe to The Pragmatic Investor. As always, I hope you enjoy this conversation as much as I did. All right, welcome back to the show by popular demand. Amrita Roy, Pragmatic Optimist. Thanks for coming on.
Of course. Happy to be back.
Awesome. Well, I know that people really enjoyed the last interview we did, so here we are again. It's time to give the people what they want. So first off, of course, we're talking now, of course, 1 week after the Nvidia earnings, more or less, they released those earnings. And of course, it was a very anticipated moment for the market. Everyone is talking about AI, Nvidia, and, the stock just keeps chugging along. Of course, we saw them, everyone was expecting the company to do very well. They did even a little bit better even. And, the stock keeps chugging along. I mean, despite defying perhaps all kind of laws of valuation. But of course, there are some reasons behind this. I'd love to get your take, first of all, of course, on Nvidia, those earnings in particular, and then maybe just more generally in terms of the global AI narrative, how you feel about this kind of AI narrative and this investment thesis.
Sure. Lots to unpack there then. All right. So NVIDIA had a lot of expectation going into the earnings season. There was a lot of bulls on one side, bears on the other, and yet NVIDIA came out stronger than ever, beating estimates on both revenue and earnings and setting higher than expected guidance for the first quarter of FY24, I believe. Now, when it comes to NVIDIA at a high level, we are thinking about the whole CapEx boom in AI, and that's correct. But actually, what is really interesting to me when it comes to NVIDIA is when I look at its history, sort of how over the course of the last 2 decades, it saw its GPU applications sort of like expand. And I'll sort of just give you a little bit of a history because it's really fascinating, because the company was founded in 1993, and between 1993 to 2000, its sort of application of GPUs stuck to accelerating the graphics rendering part. And that was it. And now between 2000 and 2010, with the proliferation of internet, gaming becoming super popular, the application of GPU just widened as there was a higher demand for, GPUs for designing faster simulations, immersive visualizations, things like that. Come 2010, 2017, or 20 really, the application space of GPU further widens with the advent of cloud computing and crypto. And now, from 2020 to now, right now, we have a further expansion of, if you want to call it the TAM, the total addressable market, where we now have AI, and crypto. And the growth story of NVIDIA just doesn't take a stop, like it's continually growing. Now, when you talked about the whole NVIDIA earnings, of course, it was a beat. And it's related, obviously, to the much higher than anticipated boom in the AI CapEx cycle. And that has sort of led to demand surging much higher than anticipated. So there's a supply chain constraint, and NVIDIA sort of sits at this market leader position where it's taking advantage of the whole pricing power that it now has. The question that comes to mind, obviously, is how long is this CapEx cycle going to continue? And if I look at sort of the past, NVIDIA usually used to have like maybe 4 or 6 quarters of growing revenue, where its stock would just go up, and then it just had a cyclical correction with maybe 2 to 3 quarters of like, when the CapEx cycle sort of flattens out. Now, this time is really interesting because AI, the whole, the training the LLM models, which comes with, having the capability to do accelerated computing, comes in actually 2 stages. The first is the training part, and the second is the inference part. The training part, NVIDIA is a leader at the moment. And the training part, I just want to highlight, it's basically like you're training the models to recognize patterns. Like this is a triangle, this is a square, this is a circle. The inference market, on the other hand, is when the AI models or the LLM models, large language learning models, actually go and apply that knowledge in a broader space. So whether it is in the form of a chat GPT, or in the form of a mid-journey, text to image, or the most recently launched Sora, for example. So the inference market is actually really, really huge, with no point of saturation at the moment. So CapEx cycle is booming, which is good. We don't know when the CapEx cycle is going to end. We also know that AI comes in sort of 2 core stages, training and inference. With the training part, I have a feeling that it's sort of cyclical in nature. So I'm guessing, like, maybe we will have a spike this year, maybe into next year. We are already into 2024, so we'll have a spike. We will have a strong year this year, and then we'll sort of like taper off before again sort of picking up again. But the inference market is actually where probably the real growth lies. And the good thing about this report, apart from NVIDIA obviously beating on all areas when it came to revenue, gross margin, operating margin, free cash flow, and whatnot, was that its inference revenue is now 40% of total revenue. So that is actually super, super optimistic. And I think as long as, and there are going to be probably a lot more players coming into the inference market, in my view, in my sort of investor-lensed view, over the coming years. So I think that is sort of where the optimism is currently, that the inference market is booming. Looking forward, is there reason to keep on being optimistic about NVIDIA? Well, sure, at the current pace of its continuing to beat revenue guidance and earnings estimates, why not? And the company also sets guidance on a quarterly basis. So we just, we're sort of like riding the boom at this point, with not knowing really when exactly or how things might sort of taper off, if it does, and how it will look like. Also, I would like to point out that NVIDIA's forward price to earnings ratio is probably around like 30 or 30, between 30 to 35, which is not insane in today's market conditions of like heightened valuations. So that's something else to think about. But moving forward, I think there were lots of things that its CEO Jensen Huang said, which I think I like. And then there are other areas which are sort of unknown unknowns for me, which I consider as risks, which I'll outline in a bit. So what are the 4 things, maybe 3, as I go through it, I'll remember, that Jensen Huang said during the call that I liked. First is that obviously we are seeing the accelerated computing sort of at a tipping point, and the transition away from general purpose computing to accelerated computing, right? And as we see this sort of shift happening, the company is also sort of diversifying its revenues across multiple different industries. So it's no longer just like sort of, large, like hyperscaler revenue that is its
Mm-hmm.
core thing. It is actually, it is contributing 50% of its total revenue, but the company is also diversifying revenue across, let's say, enterprises. We saw enterprise adoption this quarter, specifically from things like ServiceNow, Adobe, who are, very rapidly sort of building their own co-pilots, for example, to release to their audience base. And the third thing is obviously the consumer, like companies like Meta, for example, and Meta is on this. I mean, since the company tanked from its all-time high, well, it has created a new all-time high now, but its prior all-time high, it had sort of like re-disciplined itself. It has been just on a tear, absolutely. And so it is revamping its generative AI efforts, to help the overall advertiser space. So I think the company's sort of focus to diversify revenues across industries as the whole sort of shift takes place from general purpose computing to accelerated computing is something to be optimistic about. A. B. I also like the fact that the company is rapidly innovating on its hardware and software sort of product innovation cycle. So it has accelerated its GPU production cadence right now from 2 years prior to 1 year right now. And the third part is this whole generative AI market. And I think there is going to be a proliferation of applications where, we have already, I mean, the main ones we know, obviously, ChatGPT, Midjourney, there is the new kid in town, Sora. And when you look at what is happening in the background, that is a lot of inferencing, that is a lot of computing. And we need the architecture to constantly get better over the course of time. And with the inferencing market kind of like a secular part of the overall AI theme, I think stands to benefit. I mean, yeah, NVIDIA will stand to benefit as this sort of remains like a secular theme within its overall different revenue categories in the coming quarters, in the coming years. That's sort of my high-level take on NVIDIA. Now, there are obviously risks. I know that NVIDIA is sort of the market leader when it comes to its H100 chips. I know there are lots of like companies that are starting to build their in-house chips. Like Microsoft, for example, I know started to build a networking card recently. And there are multiple other names. Plus, then there is obviously competition that probably is going to come from AMDs or the Intels, for example, specifically AMD. So there's a lot of unknowns over there. That's one. The second part is, the second risk, I would say, is just the macro cycle. I mean, we have seen this AI capex boom. That's great. But what happens when there is a downturn, if there is one, and economy comes in cycles. So there's just unknowns and how much optimism is actually baked in versus how much optimism is just going to like run away when it doesn't meet expectations is unknown, obviously. The third thing is just the whole idea around like, ethics and regulation. And that's a whole like black hole on its own. It's a continuing process of revisiting that topic and seeing like how different players are sort of aligning with the ethics code of AI and what does it even mean moving forward with such rapid innovation. So I think these are sort of the three main areas of risk that I see. But I mean, given where sort of the macroeconomic cycle is at the moment, I understand why the stock is riding the way it is. And I was actually looking at it yesterday. I saw like, the Max 7s, for example. And Max 7s obviously include NVIDIA. And if a portfolio did not contain NVIDIA or Max 7 as a cluster between 2012 to now, that portfolio would be down compared to the portfolio which has Max 7 by 25%. So there is that inherent, obviously the inherent feeling of FOMO that obviously comes with that. So the best way that I look at these things is that these are like structural, secular stories that will shape the next phase of innovation. And instead of just like, I don't know, betting all your wealth on just one stock, it's best to just sort of like look at the space holistically and maybe do like a sort of a dollar cost averaging over the course of time. So you can ride the ebbs and flows of the cycle and have the kind of returns that will, that your portfolio deserves. But that's my take on NVIDIA per se. I know you asked me sort of where I see the overall AI space. I'm going to take a pause here. I'm going to see if that answered your question before I move into the second part of the question.
Yeah, absolutely. Let's just touch up on Nvidia. Just as a quick recap, of course, you did mention that transition kind of from CPU to GPU. That is kind of the wave that Nvidia is riding, and I know the CEO Jensen did talk about that in the latest earnings call. Now, I did think it was very interesting what you mentioned about the cyclicality, right? And of course, a lot of people would mention that, semiconductor stocks or the semiconductor market is generally quite cyclical. But you did mention, correct me if I'm wrong, you said that there's the cyclical part associated to what might be the language learning, but then there was the kind of pro-cyclical, more secular part related to the inference, right? So okay, so then you're saying that to that extent that maybe there's been like a shift in that regard, right? That we're not going to see that kind of more volatile chip market.
I think so. I think, or at least maybe until like, because there's so much innovation actually happening in this market at the moment with so many players, and well, there's excitement for the innovation, but there is also like maybe too much optimism that is being baked into valuations, which is a separate issue. But I don't think that this cycle is necessarily going to play out as sort of the boom and bust cycles as we have seen in the semiconductor space over the last, since its inception, really. I feel like there is to your point, I think there is a cyclical part and a non-cyclical part. And as the space becomes sort of, not consolidated, as I think, sort of the hype slowly fades away, people have sort of a understanding, sort of a grounding really on the pace of the whole thing that is moving at like, I don't know, at the speed of light. I think there'll be like lots of new players that will come in, and the competitive forces in this place might be interesting to watch as well. But for now, it's definitely NVIDIA is sort of probably taking most of the like winner takes all kind of a stance at the moment, which is true for pretty much all of the Max 7s, if you really think about it.
Right, absolutely. It'll be interesting to see again. I think it seems very clear now that, Nvidia is the king of the hill. Somehow it wasn't so clear 2 years ago. Maybe, in 2 years we'll be looking back and someone will be saying, oh, well, of course someone was going to come in and take some of Nvidia's pie. We'll obviously have to see about it. But I'm also interested to know, you talked about the different risks, for example, as a kind of more macro level. So if there was a bit of a downturn, obviously that would be a risk to Nvidia. Would that be, let's say, a larger risk to Nvidia than another stock? Then would you say that maybe because Nvidia does trade at those high valuation multiples that it would suffer more in a downturn, or could it just survive just based on, because people still need all those chips, and even if there is a downturn, they'll actually do even better.
Yeah, well, if there's a downturn, the stock goes through a correction and sort of the whole story remains, I think it's going to be a great point to like add into the position. But to your point, like, will NVIDIA suffer more? The truth is, if I'm not wrong, the company is pricing in for like a 75% growth in EPS year over year. So its price to earnings ratio of 35 actually consists of that expectation that EPS, earnings per share, will grow 75%. If that is hit by any margin, the stock will fall. It's basic sort of linear math. So that's that. But yeah, I mean, should the stock fall, but the overall story of AI remains like we saw basically in 2022 when all the Max 7s fell tremendously, like taking out what, like close to $4-ish trillion away from the market cap. It all came back roaring in 2023. And ultimately, the reason some of these companies, or the Max 7s in this case, came back roaring in 2023 was because it has just fantastic operational performance metrics, like these companies are able to, they have pricing power. They're able to convert that operating margin into free cash flow. They have cash buffers, and just generally, like, most of these Max 7s you see are the winner takes all kind of a moat to it. So I think as long as these sort of characteristics remain, any downturn is a moment to probably bulk up your portfolio allocation towards NVIDIA specifically in this case.
Right, that makes sense. And going back to kind of the broader picture of AI, do you believe that there's any kind of, so we've seen this narrative kind of play out before, right? I mean, a few years ago, everyone was super excited about electric vehicles. Now Tesla is probably, getting quite a lot of hate from investors. It's been doing nothing for a long time. A lot of those more speculative Chinese EV companies, in the absolute gutter, um, unfortunately for me and some of my investments. Um, Obviously, to an extent, we saw that with crypto a bit as well, like, oh, at some point, altcoins and blockchain was going to be the new thing. And I think, like always, it's that kind of thing like, well, these are great technologies, but we're getting a little bit ahead of ourselves. Is there a degree of that happening? Because also I see a lot of, Nvidia, for example, is investing in a lot of AI companies. I mean, would you expect at some point to be some kind of consolidation here and maybe kind of a little bit of pullback, at least in that kind of AI hype?
It's a really good question. I think for now, if you really look at where the value of AI is accruing, it is actually accruing to the producers of the technology. It is not yet actually properly accrued to the people who are using it, to be very honest. Yeah, there are lots of AI startups that are coming up, which some of them I know of, some of them just like come up almost on a daily basis, doing something in the space of AI, or just like green AI washing it somehow. Don't know. I would also like to point out that I know that VC spending in AI is not back to its previous
Right.
highs, if I am right.
Yeah, I think that's
That
correct.
might
Well,
change. Yeah. And that might change this year if interest rates fall and the whole sort of deal making, VC spending, the whole market sort of again mushrooms up. But that's something interesting for me as well. But yeah, so to my first point, like, right now we are primarily sort of seeing the value accrue to the producers of the technology or the infrastructure layer. It has not really sort of come down into the application or software layer just yet. And I think there is tremendous value in that. There's going to be a ton of companies that will pop up. At the end of the day, I think ones with sort of real competitive moats, or sort of most importantly, balance sheet rigor, despite being startups, will actually stand to benefit. Because I also believe that this decade will of macroeconomy will not be sort of this very, very low interest rates, low inflation kind of a scenario. This decade will be one where interest rates remain at higher levels and inflation sort of just keeps coming back up again, with AI possibly like clamping down with productivity gains. But that's sort of my take. So I think balance sheet rigor, and sort of being able to convert your revenues into operating margins into free cash flow is really important. I also think that, I mean, I'm actually like, I think in the consumer AI space, I think there is a couple of like, interesting shifts that may happen personally that I sort of like read about or curious about. And I think like when it comes to consumer AI, there's probably a lot of value that can happen at marketplaces or at markets that sit at the intersection of like high consumer friction and high personalization. And what are the industries that sit there? Like things like tutoring, or fitness, or therapy, um, your tax filing, for example. So you have either an in-person tutor, for example, who charges you $50 an hour. And on the other hand, you can use Duolingo to teach you math or English for an hour. You pay a subscription, you sort of redo the math for an hour, and it turns out to be like 50 cents an hour. So you have the in-person experience, which is costing you $50, and like the app experience that is like 50 cents. There's a surplus of like $49.50 over here. And I feel like as we progress through time and more sort of AI native apps come in, a lot of that surplus can actually be possibly realized. Not maybe all of it, but maybe some of that. So there's maybe some of that, yeah, surplus will be realized with, and that's an interesting sort of area that I think is worth looking into. And the other thing that I also look at is sort of marketplaces and the evolution of marketplaces. So, you know, we started off with like yellow pages back in the 90s or when not. Then we moved to the internet marketplaces, which where you have Amazons, eBays, Zillows, things like that. Then we have mobile marketplaces where we have things like DoorDash or Uber. And now we have this unknown called AI marketplace, where we might see a lot of like AI native companies once again, like, you know, innovating on that space. And it's just a really interesting space to watch and see how value and surplus accrues.
Absolutely. And I appreciate you. So that was going to be my next question, kind of highlighting those kind of other areas where possibly one can invest. It's interesting. You did mention Duolingo, which is, of course, a publicly traded company, but you did write about them on Seeking Alpha in a not so flattering way, I will say.
I did put a sell on it, and the stock was, I think, around like 210 and things like that. I mean, I think Seeking Alpha is more like sort of immediate, short-term focused horizon. So I do think there's going to be like, you know, the stock's not going to move anywhere. But I do like the fundamentals. I think the fundamentals are solid. It's just the valuation too steep. Not going to have a high allocation to it.
Right, absolutely. And you know, valuation is going to become important at some point, if not now, you know, at some point it will. And I wanted to get then into the kind of general macro picture again, because you did kind of cover that a little bit, your expectations for inflation over the long term. And of course, over the shorter term, we have had that narrative basically shift quite a bit. Obviously, after that last CPI report, people once again afraid of inflation. What is your outlook for 2024? What do you think is kind of pushing the needle in terms of inflation, and what do you expect?
Sure. I think we've entered a very interesting stage. I think the last time we talked back in November, I said inflation, there are inflationary forces that are just secular in general at this point, with like high fiscal debts, aging population and whatnot. But I said in November that inflation is going to drop from current levels. It did. And then right now it is like not back to the Fed's long-term target, but sort of again starting to reaccelerate. Is this again sort of a new cycle? That remains to be seen. So to just backstep a bit, we actually went, just to recap historically, we went from a period in 2020 of excessive, of highly accommodative Fed with a high fiscal deficit, Feds upping their balance sheet size to fight the COVID pandemic and the whole situation, to 2021, where fiscal stimulus dropped a bit, but the Fed remained accommodative. Inflation started to rise, but the Fed was like, this is transitory. To 2022, when the Fed was like, oh no, we messed up. Inflation is not transitory. It is very much in the system. So we're going to come at it hard. And they had the most harshest, most aggressive rate hiking cycles since the Volcker era. And since then, we have obviously hiked interest rates 11 times. We have reduced balance sheet, yet maintained liquidity at solid levels, which has enabled the stock market to reach new highs. And the 2023 story was essentially about the tug of war, keeping forces equal at both ends when it came to like maintaining liquidity conditions, as is driven by the Fed bill issuance and the QT, quantitative tightening, that was happening. So where are we in 2024? So one of the reasons, or three of the main reasons that the US economy still hadn't fallen into a recession despite this really crazy QT and aggressive tightening was because consumers were flush with cash, labor market was strong. Number two, corporates. Look at S&P 500 companies, like most of them have, they have debt that is not maturing anytime soon, and they have locked in very, very low interest rates. On top of that, a lot of them have solid cash buffers, which was earning interest income. So their net interest income was rising. And third, on the liquidity front, liquidity conditions remained flat thanks to reverse repo facility and the uh, and the Treasury's bill issuance that soaked it up versus soaking reserves and causing a liquidity crunch. Now, all these tailwinds that worked in favor of the markets in 2023 is changing fast in 2024. We have consumers now where savings have depleted quite a bit. Labor market is a tale of two tales, and we can talk about it later, but I'll just keep it at that. It's a tale of two tales. On the corporate front, there is growing risk of like S&P 500 companies are all right, big banks, well capitalized, but there is just growing uncertainty about the whole like CRE space and how it's going to commercial real estate space and how it is going to affect smaller regional banks. And the liquidity front, we have the reverse repo facility, which is almost mostly depleted, which is no longer going to act as a tailwind to overall liquidity. So tailwinds turning into headwinds. So that should put us into a slowdown, right? Technically, yes, but unfortunately, we live in a complex environment where there is just really high fiscal debts, and that's not going to stop. So, and that is going to continue to push, upward pressure on the economy. We are already seeing sort of how the divergence is affecting even stocks, for example, the divergence in monetary policy and fiscal policy. We have companies or banks like New York Community Bank, which has dropped 40%, whereas you have American Express, which is soaring and soaring because certain parts of the population are still quite wealthy. Which brings me to my second point. Yes, the overall tailwinds are turning into headwinds, but at the same time, the discrepancies between haves and have-nots are widening than never before. 50%, or the top 50% of US income households own 94% of the assets. And the other 50%, the bottom 50%, own just 6% of the assets, but more than 50% of the debt. So the wealthy or the top 50% are actually gaining from the overall sort of high inflation, high interest situation, whereas the squeezing is coming on the bottom 50%. So that's the second part. And this is, again, sort of the push-pull effect that is happening on the inflation front, which I think is going to continue onwards. And at the same time, the last time we spoke, the bond market was like sort of all jittery, especially at the long end. And since then, since the sell-off, the bond market has calmed down. The long end has dropped. Since then, it has gone up a bit, but it's just driven, and it's driven by moderate inflation reports that happened in between before the last one, or moderate job reports before the latest one. So the yield curve was bear steepening, it fell again, and now it's again sort of like flattish. And this sort of like retightening and then loosening of conditions actually has spurred up activity in the manufacturing sector. It has spurred up activity even in the lending. Overall bank lending conditions are actually getting a slightly better. And number three, like the overall deal-making business is kind of back in business. We saw Capital One acquire or bid to acquire Discover for $35 billion. And that's also sort of like showcasing that, hey, are we going to see a reacceleration? So I think overall, the easy part of the inflation inflation controlling is over. Like from the peak in 2022 to now, I think the easy part is over, and now comes the hard part of like whether from here onwards it's going to get down to 2%. And I don't think that's going to happen that easily, given sort of the push and pull that is happening with inflationary forces and deflationary forces. At the same time, the problem is that the longer the Feds keep rates at high at this level, risks to the commercial real estate space, which I wrote about, just gets larger and larger, with potential risks of the regional bank contagion. Now, is that a risk that the Fed is going to take, or is it going to just sit it out while keeping rates steady, is to be seen. So that's where I'm at. I think, to summarize, I think the easy part of the inflation fight is over. It's now sort of balancing the forces that is going to be the tricky part moving forward.
Yeah, it's very interesting. I like the way you kind of make that comparison, saying, labor market is kind of a tale of two stories. We could say the same to an extent with stocks as well, kind of maybe seeing the whole economy to an extent and the whole market kind of, show that kind of big divergence occurring, maybe to a larger extent in society, right?
Yeah.
And now, in terms of the liquidity, again, I think it's like you point out very well, all those forces coming in, maybe reversing. And to an extent, though, it does seem like now the Federal Reserve might kind of be caught right between kind of a rock and a hard place.
Mhm.
Basically, I mean, there's already been a lot of speculation, right, that the Federal Reserve is going to basically have to taper off QT because the reverse repo facility is depleting. Like you point out, there is also a possibility that, if obviously, well, if there is problems with commercial real estate, they might lower interest rates. They might even, extend another round of emergency funding or whatever they want to call it this time.
Mhm.
Um, is that something you see then? I mean, it seems like there's a risk here that, the Fed might have to act, even if like inflation comes a bit too strong, they might still have to act, and that would maybe keep inflation, higher than a lot of people expect, perhaps.
Yeah, absolutely. I think if a CRE, if a commercial real estate issue occurs whereby we see small banks, regional banks
Mhm.
starting to have liquidity issues, I definitely think that the Fed is going to re-extend, rename the bank term funding program to something fancier. I don't know, but essentially a form of that where, the small banks can either have an avenue to get recapitalized, or, I'm also looking at like maybe, while that is an option, I also see like banking consolidation as another option.
Absolutely, yeah.
These two things can happen simultaneously. And yeah, like I mean, at the end, at the end of the day, too, while it is not an immediate mandate of the Fed to maintain stability in the banking system per se, like it talks about maintaining stability in price and and ensuring optimal employment. But should a banking crisis happen, 100% it's going to come and provide liquidity like it did, even when inflation was already quite high in 2022. And yeah, markets
Mm.
liked it. Yeah, I 100% believe that.
Mhm. Absolutely. And I guess the other part of the puzzle right now is the fiscal side, right? Which of course has become a much larger part of the economy in the last few years. Of course, we have election year, of course, fiscal spending this year ramping up as well.
Mhm.
Do you see that also basically contributing or to off-put maybe some of that liquidity drain and maybe actually helping support markets? Of course, we do know statistically election years are a little bit better than normal. Do you see that as a factor at all?
I do think that, well, ultimately, fiscal deficit is a form of adding real economy
Mhm.
money. So as long as fiscal deficit is ongoing, it sort of boosts the economy up in some form or shape. Given that it's an election year, I think there are certain dynamics in play that I, I'm not an election year expert, to be very honest. But at the end of the day, like I wouldn't be surprised if, there's some form of like a stimulus boost that comes
Mhm.
right before the election is due. Uh, the thing that there are a couple of things actually. There are two things actually. Uh, with if the treasury is issuing debt, in this case, let's assume that they're issuing treasury like the bonds, not the bills. Um, while the Fed has technically finished their QT, or it's still going to be a net negative for bank reserves.
Mhm.
If you know what I'm talking about, unless the Fed is actually doing QE,
Right.
quantitative easing, whereby they're essentially buying off this debt from the treasury by
Mhm.
printing reserves, just the banks absorbing or the private sector absorbing this treasury issuance is going to be
Mhm.
net negative for liquidity. I don't necessarily think that, the overall, like I believe that as soon as reverse repo is up, to your point, I think the Fed is going to stop quantitative tightening right away. In fact, it might even start to like do a boost of like QE to sort of add some extra cushion, just not to like have a repeat of 2019 repo crisis.
Right.
That's that. And the second part is that ultimately, with fiscal debt, it's this whole like sort of fiscal debt spiral at the end of the day, because when the feds keep rates high, it ultimately affects government. And when government debt as well, who has to pay more interest income? But unlike you and I, who can default and go bankrupt and shut our shop, which is terrible, the government can still print money. And when it does, it's just like taking on additional debt to pay the interest income. And it just sort of like just hovers in the system in a vicious cycle and keeping inflation very much active in the system. And it's very much a phenomenon that is going to take place in this decade, which is obviously, I think, something that the Fed is aware of, and it's going to stay on its guards. There are obviously deflationary forces too from AI and whatnot, but this is definitely a story that is going to remain throughout the rest of this history of, not the history, throughout the next phase of the United States as it continues to spend more than it produces.
Yeah, absolutely. I think that makes a lot of sense. I'm recently reading Lynn Alden's book, Broken Money, and of course she compares the current situation. Of course, she's written plenty of articles about it too, kind of to that. I would say that maybe wartime 1940s and 50s kind of basically fiscal driven kind of inflation, and yeah, basically that idea that spending kind of getting a bit out of hand. But funnily enough, of course, no war this time. Simply other stuff kind of getting in the way there.
Absolutely. I'm actually looking forward to reading her book. I'm yet to buy it, but I I think she's just a rock star at the stuff she talks about and writes.
So it's pretty interesting. And now, because we have seen on a more global scale, for example, countries like UK, Japan, now kind of flirting with recession. Obviously, there seems to be some idea that the economy, at least globally, is slowing down. Do you think that is going to affect the US at all? And if not, what is kind of the differentiating factor here? How's the US doing so well when we kind of see weakness in the rest of the globe?
I think the weakness in the rest of the globe will definitely play a part for sure. But whether that will end up in a recession in the US is a big question mark, in my opinion. And I think once again, it is sort of the inflationary forces I talked about before, driven by fiscal dominance, driven by the haves who have so much spending power given the amount of wealth they have acquired and things like that. That's sort of just going to keep the economy like chugging along. So I am not of the opinion that the US is going to like see a 2008 style recession. I think may have we may have periods of rolling recession or maybe a mild recession, but that's sort of like where I sit. When it comes to, like I think what we are seeing is sort of in the global economy, it's just really interesting because maybe in the past decade or so, or even before, the monetary policy of the US would sort of dictate where the rest of the global economy would stand as well. Given sort of if the US Fed is hiking rates, and let's say, I don't know, India is not, then depending on like the GDP growth rate or the inflation rate and the whole FX, the foreign exchange reserve situation, it will the health of the Indian economy will be determined. So it was like always sort of this, the US monetary policy dictates how other economies sort of react to it and respond. Obviously, dollar being the reserve currency and used for trade worldwide, still in dominance. I think I was just thinking. I mean, I was thinking about your question actually before I'm thinking how to answer it. I think there are 5 forces over here, and at the moment, I mean, the U.S. macroeconomic situation governing how other countries react is like a stale story. It's partly true now. But I think most importantly now, we are sort of seeing 5 forces, and the interaction with these 5 forces, the dynamics and how each of these countries are sort of positioned in this whole realm is dictating like how each of these economies are doing, and sort of the prospect forward. And those 5 forces are the aging population. Let's face it, like, I mean, US has an aging population. Europe has an aging population. China now also has an aging population. Japan has the world's famous aging population. India, on the other hand, is far better when it comes to an aging population side. The second part is like the whole, like the idea of reshoring to de-risk supply chains, which can inherently be quite inflationary in the start. The third part is to do with the whole area around energy security. Well, US is mostly energy abundant to a certain degree. I shouldn't say energy abundant just so freely, but regardless, like we saw, like, the high energy prices crippling Europe, for example.
Right.
And the whole sort of, move to net zero and what that exactly means is, again, like, there's maybe short-term inflation, there's short-term inflationary and long-term deflationary forces. The fourth thing is obviously AI and how different economies around the world are sort of setting themselves up in this whole race again to position themselves in the next phase of the next part of the innovation cycle. And the fifth part is fiscal dominance. Like everywhere you go in the world, governments are for the most part, governments are actually spending more than they're making, more than they're manufacturing or exporting. So the dynamics of these five forces actually determining where all these economies sit. And I think sort of where the current state of like Europe is with UK and Germany UK has fallen into a technical recession and Germany has been in contraction for, I think, almost 2 years at this point. It's because of the aging populations, because of the energy security issue and things like that. Whereas with China, we are sort of seeing maybe 2 year or more situation of this prolonging property deleveraging that has just driven away investors in bulk and the repatriation of profits. And whereas, like we see with India, for example, who's sort of sitting in the right balance between all these forces and seeing sort of the sweet end of the deal where there are capital inflows and things like that in the country, as well as, just alignment on all fronts to drive up technological innovation and competitiveness and things like that. So I mean, at the end of the day, to answer the question of whether global weakness is going to affect US to tip it into a recession, I don't think we're going to see like where major global economies are all going into recession at the same time. I think that world is over. I think we're going to be selectively seeing different global economies maybe having their own cycles. And depending obviously on the export import, the whole trade surplus deficit cycle, we may see some cyclical aspects in the US economy. But once again, I think the overall narrative around the overall forces of inflation that are currently present will not will not make a recession like 2008 quite likely, in my opinion.
Absolutely. I think that's a very interesting framework. And, kind of just based on, those ideas that you put forth, it does seem like the US could hold a kind of a competitive advantage there, right? I mean, the US, yes, obviously aging population, but, despite their reputation for building walls, they do take in more immigrants than anyone else. On the other hand, they do still have the best, companies. Of course, they're well positioned to benefit from AI. Fiscally, obviously, being the reserve currency, still kind of, enjoying basically the ability of funding themselves quite a bit. So it does seem like, the stage is set. I think Warren Buffett not this latest letter, I think the one before that, his shareholder letter, he talks about the American tailwind. So he kind of, obviously well known for betting on America. Would you say that's maybe something that you think could continue over the next decade or so, that kind of American tailwind and what we've seen really in the last few years, that kind of outperformance in the US economy and, to the point, more US stocks?
It's a really good question. Will I see outperformance in the US stocks over the next decade? I think sort of to answer your question on like the American dynamism and whether the tailwinds of the American economy is going to keep it afloat despite sort of the whole irresponsibility around the fiscal side. I think partially yes. There are risks, obviously. I think especially as we sort of move through the late stage debt cycle, divergences in the haves and have-nots is just going to create more and more sort of instability when it comes to politics or when it comes to just like, the society functioning in general. But when you look at it, the whole sort of the AI boom that we are seeing right now, a lot of it is actually focused. Well, different countries are working on their own initiatives, but there's the whole sort of move, the whole the realm of AI and the whole boom in AI that we are seeing is driven primarily for now by US companies, the OpenAI and whatnot. So I think as that sort of pans out into like the next phase of the innovation, where it actually sort of creates productivity acceleration, where it actually creates jobs that we are not even sure exists today, I think it's going to just be a boost to the consumer morale, consumer confidence, and just the general wealth effect that comes with every like new innovation cycle, where we see, goods becoming cheaper or lives becoming longer. And I think that the fact that AI innovation hub is still in the US, it has that sort of upper hand, probably in being able to navigate the economy in a more careful, but like not like wrecking it, but like in a more careful, but like still solvent way over the next, for the next maybe 5 to 7 years. 10 years is a long time frame. There are lots of things that can happen. So 5 to 7 years.
Do you believe that ultimately AI will be a kind of a leveling technology that will maybe break this current dynamic we've seen, right, of higher separation, that it actually might actually serve to kind of level out the playing field to an extent, or maybe the opposite?
That remains to be seen. I mean, right now, unlike the internet era, though, like the internet was sort of like, this is open source. Anyone can build anything on top of it. You look at AI, the the holders of AI are still sort of the Mac 7s, if you really think about it. So there is obviously the central ownership over there, which has its pros and cons. That's something to think about. But I think in general, when I look at AI and the kinds of things it can do today, I think it's definitely going to unlock a lot of human creativity when it comes to like different forms of work they do. They'll be able to do more sort of impactful work, which is, definitely good for the overall self-actualization, realization that people talk about. In fact, I think Jamie Dimon, a few months ago, he said that, oh, AI is going to like solve cancer, make us live for 100 years, and then we're going to work like, I don't know, 15 hours a week or something. And I was like, the last point I'm not sure about, because like I remember reading something that John Keynes had also said that, with the whole industrialization, human beings are going to actually work lesser and lesser. That is not true. Innovation has improved and our lives have become faster and efficient and whatnot, but we're sort of, just morphing into creatures where we're doing different sort of work to fulfill our life's purposes and things like that, right? So I think on that front, AI is definitely going to allow human beings to, do more interesting work, do projects that actually matter versus, sit down at a desk and do, I don't know, entry-level data jobs, which is mind-numbingly painful. I also think it will flatten management hierarchy, absolutely. As more and more, I mean, we're already seeing like a lot of companies laying off workers. While they're not necessarily always saying that it's because of AI, the underlying implication is that. And some companies are outright saying, for example, we are not hiring because a lot of these jobs can already be done by AI, or things like that. So I think it's like short term, obviously, this is deflationary. This sucks. Wages, human wages, the wages of these workers are absent and hurts their livelihoods. But I think over the longer term, it's definitely net positive. With flatter management, more impactful work done, efficient work done, as we sort of progress through the next phases.
Absolutely. There's definitely a lot of possibilities out there. Also the possibility that we'll just end up killing each other. But again, that does remain to be seen. Like you said, it's food for thought.
Yeah. I'm the pragmatic optimist. So I'm thinking about an optimistic way. Of course, there could be like all sorts of horrible ways that this technology can be used, which has been done before with technology. So human beings are unpredictable. So you just never know.
Absolutely. Well, I thoroughly appreciate you coming on, Amrita. It's been great having you on the show again. Before we log off, please let everyone know where they can find you on the internet and what they can expect.
Sure. So I write a Substack, The Pragmatic Optimist. There I connect the dots between macroeconomics, investing, and just the overall trends in culture and tech to just form the big picture, help you identify better companies, and just improve your financial and mental well-being. And please subscribe to my Substack newsletter, which is The Pragmatic Optimist. And that is sort of where I am mostly at most times.
Absolutely. Definitely subscribe to Amrita's Substack if you haven't already. Once again, really appreciate you coming on and, looking forward to the next one.
Absolutely. Thanks.
Awesome. Bye, everyone.